Why does the average investor typically earn below average market returns? Hey everyone, Sid Misra here, certified financial planner. Thank you so much for tuning into my channel. I am passionate about helping people better understand the financial system so that they can use it to their advantage. Now, before we begin, if you found this video valuable, please give it a like and please subscribe to my channel so you don't miss out on any future videos. Thank you. Research done by a company named Dalbar, and what they do is they look at investor behavior and investor returns, has consistently shown that the average investor earns below average returns. For the 20-year period ending on December 31st, 2019, the S&P 500 index, which is an index of the largest 500 companies in the US, had an average return of about 6% per year. Now, during that same time period, the average investor had a return of a little bit over 4% per year. Why the disparity? There are even cases where the average investor will have negative returns even though market returns are positive. How does that happen? What often happens is investor behavior can oftentimes be illogical and run on emotion. And it's those kind of emotional decisions that don't help investors in the long run. A couple of the mistakes that we see with investors are, one, chasing returns. A particular investment is doing well, and the average investor is going to follow that trend thinking that the past performance will be indicative of future returns, which is usually not the case. We also see that when times are bad and there's heightened volatility, the average investor will oftentimes sell out of a position at a big loss, even though that investment may actually be beneficial to them over the long run. And that selling out of the market has a lot to do with market timing. They think that they can time the market, they can get in and out at the right time, when in reality nobody has a crystal ball, nobody is able to time the market properly and consistently over a long period of time. Now, while these are bad for the average investor and these things hurt the average investor, to me, the biggest issue are not those two. The biggest issue is that the average investor is not investing towards their own goals and what they want to accomplish. The average investor is investing based on the noise that's around them, based on what other people are doing and what they're hearing and seeing in the news, on the media, from friends and family. They're following the herd. They have just all the noise that's out there that's driving their investment decisions. What needs to be happening is these investors need to be making investment decisions based on what they want to see accomplished, based on their time frame, how long they have to accomplish that, and based on how much risk they can actually handle and tolerate. If that's not the approach that they take, then they're going to follow every hot tip or new media article on which things to buy and what's going on in the market. And if you've been following the news, if you go online at all, you'll see that every single person has an opinion on what you should be buying, what you should be selling, what's going to happen in the market. There is a ton of noise out there. And if you don't have an opportunity to sit down and plan what you're trying to accomplish, how long you have, and what your risk tolerance is, you're going to fall for that and you're going to be pulled in every single direction except the one that you want to go in. Now, if you want to learn more about how to actually invest towards your goals, I have an episode here on my YouTube channel. It's from my podcast, the Empowered Finance Podcast. It's episode 11, titled, What Do You Own and Why Do You Own It? It breaks down kind of a hierarchy of how you should approach investing. And one of the first things that it discusses is, what do you want to accomplish and why? Right? Get very detailed in what you're trying to do and block out the noise. There's going to be a ton of different things pulling you in different directions, but you need to focus on what you're trying to accomplish and what your goals are. What the average investor and what people in general need to realize is your behavior is a lot more important than what specific investment you chose. Your behavior is going to dictate if you're successful or not. You need to make sure that your behavior truly reflects what you're trying to accomplish. Don't let bad behavior derail you and get you away from your goals. Again, this is Sid Misra, Certified Financial Planner. Thank you so much for tuning into this quick video. Please hit the like button if you found this video valuable, and please subscribe so you don't miss out on any future videos. Thank you.